We have Manish Singh, who's the Chief Investment Officer, Crossbridge Capital, who's joining in to weigh in on the FOMC decision that is likely to come out today. Hello, Manish, welcome, and thank you for joining us on the Rush Hour. Well, there's virtually no chance that the U.S. Central Bank will choose to raise its benchmark borrowing rate. Now, the markets are pricing in just a 1%, chance of a rate hike, according to the CME group data. But what everyone is really watching out for is, the Fed's quarterly update on what to expect, from a bevy of key indicators, whether it is the interest rates, the GDP, the inflation and the unemployment. So what is the market really penciling in at this current juncture?
Hi, good evening. Well, I do agree with you that this is probably going to be a meeting where the expectations are very low because we have seen the data, and as you rightly point out, nobody expects a rate hike. The focus will definitely be on SCP, or the Summary of Economic Projections, or dot plot. Even that, I don't think is going to be much of a game changer because those expectations keep going up and down. The key thing then comes down to the press conference and the Q&A that happens, and how does Chairman Powell react to some of the questions that are inevitably going to come with respect to rate cuts and other things in the economy. And that's where the focus is going to be. The 2-year yield, I think, will be also the focus point, because that is the one which is most sensitive to anything that the Fed does or says. And as Bank of International Settlement, BIS, has pointed out, that could cause, or that could be a cause for instability in the market if there were any sudden surprise policy announcements. Because if you look at the positioning, the market is definitely short 2-year rate in good size, because a lot of people do expect that Fed is going to maintain a hawkish tone even if they don't raise rates. Now, if that was not to happen, or there would be a signal, then that would cause a problem. So 2-year yield move probably is one thing to look at, and the press conference and the Q&A that happens.
Right, Manish, like you rightly mentioned, the 2-year Treasury yield, which is more rate sensitive, and that has been a point of concern. The rising Treasury yields, also the oil, now hovering around that $93 a barrel mark. It is likely to touch 100. It could touch $100 a barrel mark on the back of the tighter supplies and the rise in demand. Also, with the dollar gaining strength against the Indian rupee, how is this likely to impact the Indian markets going forward?
I would say that on the macro basis, clearly energy prices going higher and dollar strengthening doesn't help the Indian economy. But again, we are talking about one spot or one number at this time. If this was to continue to be a trend, and if you saw energy prices going higher, and let's say oil trades above 100, but just trading above 100 is not a big marker in itself. If it stays there for longer term, then it could cause a problem. But if we are talking about data getting soft in the US and data getting soft other places, we saw the inflation number in the UK today, which came down both on core and headline basis, and other numbers across the board, it was much lower. So it clearly points out that the high inflation story has played out, and so high inflation story has played out, but it doesn't mean that the consumers are just going to be jubilant about it, because the price level is still high. Remember, inflation is a rate of change of price level, and rate of change has come down or may go down further, but the price level does stay high. And so unless there is an interest rate cut, you're not going to see the same amount of liquidity come into the market. So those things can play a big part. But if oil gets to 100 and stays there for long term, then there will be a problem. If it doesn't, and if it just touches and then data softens and then prices come down, that shouldn't be a problem, and that should just be seen as a short-term event.
Right. The way central banks really communicate its intention is through the dot plot. Now, that is a grade that, unanimously lays out individual members' expectations of the rates ahead. Now, markets will be looking out for the subtle shifts in the dot plots, to understand where it currently stands, where is your bias likely towards? It's likely to be going to be for the dot plot for the Fed.
See, I would say that central bank is in the business of being hawkish. I mean, no central banker is going to say anything different, and especially when the headline inflation is above their target. So if you look at the U.S., the last sprint, the inflation has risen ever so slightly, but it has risen, and it is above their target of 2%. So they will definitely maintain hawkish bias, and you will see that in the dot plot as well. And they should, because they're just trying to convince the market or convince everyone that we are not going to give up on fighting inflation and the rates are going to stay high. And that has a dampening effect on wage rises, on how the industry and the businesses see their profitability, so they don't go up and ramp up prices. I think it does have an impact, because if you maintain a hawkish bias, then if you're an employee or you think about, oh, the economy is going to get worse and I might lose my job, so I'm not going to ask for higher wages. Similarly, companies might think, oh, there might be a recession if this continues, and therefore we need to not raise prices so much. And that does have an impact. So I wouldn't expect Fed to give up on its hawkish bias unless you see the data turning. And when the data turns, and it will turn, then you will see the Fed rapidly coming off that hawkish bias, just as very few people expected 375 basis point hike this year. Very few people expect Fed to cut rates, and they'll be surprised again, just as they were surprised on the upside.
Right. So Manish, while there's likely to be a pause for this meeting, there's a clear possibility that the November meeting, could see a final rate hike. So what are the chances of that? And, is the Fed likely to stick to its 2% inflation target?
In my personal view, I've always maintained that the rates are very high and it shouldn't be here, and it is causing damage to the economy. The only reason we have not seen U.S. recession or softness to a larger extent is because U.S. still continues to spend money. So if you look at the over 100 billion or thereabouts that U.S. has spent in the Inflation Reduction Act, those are just monies being spent, and that just cannot last forever. You're also going to see the student loan repayment start. That will take 100 billion off from the consumers, in the sense that there'll be lost consumption. Now, of course, that is a small percentage of overall spending, consumer spending in the US, but these things on margin do have an impact on how people feel and how expectations are set. So I would think that these things are going to play a huge target. Fed is unlikely to get to 2% anytime soon, because the US government is still spending. Wage increase is still going on. So unless you see high rise in unemployment or unemployment rising by 1%, you're not going to see dampening effect or impact of that on wage increases and other thing. So I don't think they get to 2% over the next 6 months or 1 year, but eventually they will get there. But I do see that when the rate cut starts, you will have bigger rate cuts than people anticipate. And 5.25% where we are is high. I'm not expecting rate increase in November. I think it's already too high. But again, given the biases, who knows? They might again raise 25 basis points, which again, to me, will be a policy error.
All right, Manish, thank you so much for weighing in, and thank you so much for joining in today.